look at the regulatory side, I would say let's talk about what has really changed in India. On the regulatory side, we had a very complicated 4-tier structure, and now it's moving into a 2-tier structure. You have a dollar-denominated bonds and a INR-denominated bonds. So pretty much simplified structure. And you can do restricted group companies type of lending, which we did for you. So I think that's a pretty interesting. You can do a holdco lending. So I think these are good things which are happening. These are the tailwinds. If you look at eligible borrowers, I think almost when you looked at the bond issuers because of the rating, only very few Indian groups were eligible to tap the bond market. And now I think almost every group, every company which can attract FDI can get bond, can get access to bond. And what it requires is an upgrade on, I would say, upgrade on cycle cash flows so that they can tap the market. I would say if you look at the recognized lender bit also, almost everybody who's governed and who's predictable in their behavior are actually allowed to be ECB lenders in India. The minimum average maturity period is also, a lot of things have clarified, 3 years typical, and 5 years in case of you are a foreign equity holder to the borrower entity. Liberalized borrowing limit also has significantly improved. I think there's automatic up to $750 million. And I would say the big opportunity which we have seen in last few years when RBI went after bans not to lend to NBFC, the amount of NBFCs have gone out and borrowed on bond market has been quite significant. If you look at the numbers, basically, if you look at 2024 numbers, in 6 months, the total bond market, people have gone and NBFCs have gone, almost got 30,000 crores, which was the total borrowing from bond market last year. So it's a significantly improving, and I think with the inclusion, it is expected that there is going to be a significant improvement. The cost of borrowings have come down. Corporate cost of borrowings have come down by 22 bips, what I understand. That hedging cost has come down. So therefore, there's a lot of good things happening. I think there are still bottlenecks on end-use restriction. I think we still have challenges, but I think we can find way out. There are still challenges on all-in cost ceiling numbers, but I think with the hedging cost going down and competitiveness improving because our rupee dollar exchange rate, that is becoming a much better thing. On average maturity, we have more challenges, particularly when we are refinancing. But again, I think we heard the regulator, all these things are looked at it. But in India, everything is always slow, but it's probably on the same right direction. Sometimes there are challenges on ESG based type of lending as well. But I think, again, that is, I think Robbie mentioned how we are ahead of the curve, not behind the curve on the ESG side as well. So I would say this, if you look at today, with the expectation of $2.5 trillion of debt required to take India GDP from $3.75 trillion to $10 trillion in next 8 to 10 years, the opportunity is huge. And I would say the regulators, I would say pretty much, I think very little Indian regulators can really do. It is really when you get, particularly in the cross-border bond market, it depends on when you list the company. And if you have a subsidiary which is listed in India, then obviously you have disclosure issues. But very little thing you can do. I think it all depends. And now a lot of companies, a lot of bonds are getting listed, even in Gift City, and which have a very progressive regulation. So I would say, if you look at last few years, I was reading it that Zine have really got a 2,000 crore of FCCB. Now with our markets all-time high, probably FCCB is out of window, except in very stressed company. But I would say masala bond should be very good, because I think right now borrowing in rupee will make a lot of sense, particularly when the hedging cost is lowest, and we expect a lot of money to come into India, particularly because of the inclusion of the debt in the government debt in the JP Morgan. So I would say that with that, this is an interesting time.